Welcome to the deep dive. You've sent us quite a stack of sources this week, and honestly, they paint a picture of, well, not slow shifts, but real global seismic activity.
That's a good way to put it.
We're seeing countries, central banks, major alliances basically tossing out the old assumptions. They're actively looking for shelter.
Yeah, that really is the key takeaway here. If you boil down all this material you sent, the main theme is pretty clear. We're in a global economy that's just defined by geopolitical risk and, frankly, unprecedented structural uncertainty.
Everyone's hedging.
Everyone is hedging their bets. They recognize that the rules that sort of govern global trade and finance for, the last couple of decades, they're pretty much gone.
So our mission today is to try and cut through some of that complexity. We want to give you a clear handle on 4 really high-stakes global developments happening right now.
Okay.
We're talking the struggles of Europe's economic engine, a huge new trade alliance pushing back against protectionism, gold making a comeback as a challenge to the U.S. dollar, and the Fed basically admitting they're, well, flying blind.
Let's dive in. We'll try to give you the framework for understanding how to maybe navigate this very volatile environment.
Okay, first up, I have to say, seeing the latest numbers on the German economy, it was genuinely shocking. Let's start there. Story number 1. Germany, the reliable powerhouse of Europe, is seriously sputtering.
Yeah.
You shared the E4 Business Climate Index from today, September 24th. It hit 84.9.
And that number, 84.9, it's really crucial because first, it missed expectations, and second, it's the 5th month in a row it's dropped.
5 months.
That's the lowest point we've seen since the absolute peak of the energy crisis back in 2022. So, Germany, that highly engineered machine we all think of, like a high-end car, well, its service life's been flashing for months, and now even the parts you thought were reliable are starting to break down.
And what really stood out in the sources, what's alarming, is that this pessimism, it's now spreading into the service sector.
Right. Services were supposed to be the cushion, weren't they? Absorbing the hit from manufacturing slowing down.
Exactly. But now confidence in that huge sector is just deteriorating sharply. It feels like the slump is really digging in deep.
Which brings us to the big question. Why can't the government seem to stop this slide? And the sources, they all point to these deep structural breaks on the economy.
Like what specifically?
We're talking about persistently high energy costs, really debilitating levels of bureaucracy, red tape everywhere, and these chronic, pretty severe labor shortages that just aren't going away.
And the attempts to fix it, they haven't really inspired much confidence, have they? This Agenda 2030 package the government put out, tax cuts, deregulation.
Yeah, it was almost immediately dismissed. Big institutions like Commerce Bank use that phrase, too little, too late. Just damning.
And it's not just political will, is it? There's a structural reason why it might be too late.
That's right. They're constrained by something called the debt brake, the Schuldenbremse. It's actually in their constitution.
Right.
And this rule severely limits the government's ability to use massive fiscal stimulus. Pouring billions into rundown infrastructure or offering huge incentives to kickstart things, that's largely off the table.
So like fiscal paralysis just when they need aggressive action the most?
Precisely. And on top of that internal paralysis, you've got these extreme external threats hitting the German export machine.
Yeah, one detail that really jumped out was the fear of deindustrialization. Big companies like BASF are explicitly saying they're reducing production in Germany, moving operations elsewhere, just because costs there are becoming unbearable.
And that manufacturing drain is made worse by these global protectionist threats. The sources really highlight the very specific, almost existential threat from the potential U.S. 10% universal basic tariff on all imports.
The one proposed by the current administration.
Exactly. If that actually happens, it would be catastrophic for German exports. Think cars, machinery, industries that absolutely depend on smooth trade with the U.S.
Okay, so that potential U.S. tariff isn't just talk. It's actually forcing action elsewhere, which leads us right into our next big story, this massive strategic countermove that just happened.
Right.
The EU and Indonesia finally sealed the deal on their Comprehensive Economic Partnership Agreement, CP. After, 9 years of talking?
9 years of dragging their feet. What's fascinating is how quickly they wrapped it up right at the end. And the sources, They pretty much credit the aggressive protectionism coming out of the U.S. as the main catalyst.
Really?
Yeah, it seems it forced both the EU and Indonesia to say, okay, we need to diversify, we need reliable partners, we can't be so reliant on one dominant, unpredictable economy.
Mhm.
It's like a defensive alliance wearing a trade deal's clothing.
So they felt they had to build their own lifeboat, basically. What does this deal actually mean for the market?
Well, the headline number is tariffs gone on 98.5% of traded goods.
Mhm.
But the really big immediate winner, European car manufacturers.
How so?
Get this. Indonesia currently has a massive 50% tariff on European cars.
Yeah.
50%. That wall comes down to zero over the next 5 to 7 years.
That is huge. That opens up a market of, what, 280 million people? Suddenly, VW, BMW, Mercedes EVs,
Right.
they become competitive overnight in a place they were basically priced out of.
Right. And the EU gets an equally huge strategic win on the supply chain side. They lock in a stable supply of absolutely critical battery minerals, specifically nickel and cobalt from Indonesia.
Ah, the stuff you need for the green transition.
Exactly. These minerals are the foundation of the EU's big green transition plans. Securing them independently like this, it helps stabilize their whole industrial future.
So if we need an analogy for you, it's like the EU and Indonesia looked at the main global trade highway and saw it was getting jammed up with unpredictable tolls, maybe from the US.
Right.
So they decided, let's pool our money and build our own dedicated high-speed toll-free lane just for us to keep our essential stuff moving.
That's a perfect analogy. And the implication for companies is clear. This immediately creates new growth opportunities for European automakers, and it shines a spotlight on Indonesian companies, especially those in resource extraction, that can meet those really strict EU environmental and social standards, the ESG stuff.
Okay, that leads us to another major global story, a new front opening up in what some are calling a financial Cold War. Let's talk about China's gold strategy, the Shanghai Vault.
Yeah, this is a really bold play. It's about challenging the dollar's dominance by using the one asset the dollar can't just print more of: physical gold.
How does it work?
China's central bank, the PBOC, is actively persuading other central banks, especially in the global south, to buy their gold through the Shanghai Gold Exchange, the SGE. And here's the kicker: to store that gold in China.
And this news actually moved markets, right? Gold prices hit new highs.
They did, new all-time highs. It shows how seriously the market is taking the potential for this new source of demand. But why are central banks suddenly considering storing their gold in Beijing?
Yeah, why distrust?
It's all about deep geopolitical mistrust of the West, honestly. The absolute shock event was back in 2022, when the U.S. and its allies froze Russia's overseas assets, around $300 billion.
Right, I remember that.
That sent a massive signal to nations not aligned with the West. Hey, your assets stored in New York or London, they're not necessarily safe from Western political pressure or sanctions.
So China's basically offering insurance, a sanctions-proof vault, saying, keep your gold here, away from the Western financial system's reach.
That's precisely the pitch. And you see it in the data, too. China's own central bank has been buying gold like crazy 10 months straight of net purchases. And at the same time, they've been systematically reducing their holdings of U.S. Treasury bonds.
The de-dollarization strategy playing out.
In real time, exactly.
But hold on, the Chinese yuan isn't really convertible like the dollar, is it? How does buying gold in Shanghai help the yuan if you can't easily use yuan everywhere?
That's the clever part. It's an infrastructure challenge. China isn't trying to replace the dollar with the yuan tomorrow. That's not realistic yet. Instead, they're using gold, which is seen as neutral, a universal asset, to challenge the physical infrastructure of dollar dominance. Traditionally, big gold trading and storage happens in London and New York.
Yeah.
By moving more of that trading and storage to Shanghai and pricing it in yuan on the SGE, they gradually, organically increase the international use and influence of their own currency. It makes the yuan a more viable alternative for settling these kinds of strategic asset transactions.
So the big takeaway for you, if you're watching the markets, is that gold's role has fundamentally shifted. It's not just about hedging against inflation anymore.
Not at all. It's become a long-term structural strategic asset. It's a hedge against geopolitical risk, specifically the risk of Western financial sanctions. Its value is now tied to that diversification need.
Absolutely. Okay, let's turn to our final deep dive topic. This one brings all this structural uncertainty right back home. A really significant admission from Federal Reserve Chair Powell. He basically said the old rule book for managing the U.S. economy, it's obsolete.
It really was a striking moment. He essentially said, look, policy decisions used to follow relatively predictable economic models. But now, External factors are just overwhelming those models.
What kind of factors?
Everything. Fragmented global trade, shifting immigration patterns, unpredictable geopolitics, massive, sometimes erratic fiscal policy changes. It's also intertwined now that predicting how the economy will react, and therefore what the central bank should do, is exponentially harder.
So the consequence is the Fed can't just rely on forecasts anymore.
Pretty much. They have to be incredibly flexible, truly data-dependent, as they keep saying, constantly juggling the risk of letting inflation flare up again versus accidentally tipping the economy into recession and causing major job losses.
It sounds exhausting.
It signals a structural change in how we all, especially investors, need to think. Here's an analogy for you. We used to be driving on a familiar, straight highway. You kind of knew the destination, the speed limit, how policy worked. Now, we're navigating a dense, foggy mountain road at night. You have to constantly check the map, check the weather conditions, be ready to slam on the brakes or swerve unexpectedly. Uncertainty is the only constant now.
And that uncertainty has direct market implications. Experts noted Powell specifically mentioned concerns about asset prices, that they might be overvalued.
Yes, particularly in those high-growth sectors like tech stocks. That's a pretty direct warning shot from the Fed chair, suggesting that market adjustments, maybe even sharp ones, might be needed to get valuations back in line with this new, uncertain reality.
So what does that mean for you making decisions right now?
It's pretty straightforward. First, stop trying to predict the Fed based on simple indicators. It's too complex. You need to plan for multiple scenarios, be ready for them to ease policy, hold steady for a long time, or even suddenly tighten again if inflation surprises them.
Okay, multiple scenarios. What else?
Second, given that warning about high prices, you need to be more conservative. Really scrutinize company valuations, especially those high-flying growth stocks that depend on very rosy future predictions. The margin for error is just much smaller now.
Got it. Be careful with valuations.
And finally, flexibility is absolutely key. This high level of structural uncertainty demands serious portfolio diversification, looking into risk hedging strategies and maybe keeping a slightly larger cash position than usual.
Why cash?
That cash isn't just about defense. It's about optionality. It gives you the flexibility to act, to potentially capitalize on opportunities when the market inevitably swings because of these unpredictable external shocks.
Okay, so let's recap. We've hit 4 really key global currents today. There's the deep structural weakness and political gridlock in Germany, the creation of these counter-protectionist trade blocs like the EU-Indonesia deal, driven by U.S. policy.
Right.
China's strategic use of gold via the Shanghai Vault to challenge the dollar's financial plumbing. And the Fed basically declaring that this era of deep structural uncertainty is the new normal.
And these forces, they're not separate threads. They're all interwoven, rapidly reshaping the global landscape. Hopefully this review helps you understand why stability feels like the exception now, not the rule, and why proactively understanding these global risks is just paramount for protecting your financial decisions going forward. It's all connected.
From a factory floor in Germany to a gold vault in Shanghai, it really is all connected.
And maybe the final thought to leave you with, connecting it all back. Given that just the threat of potential U.S. universal tariffs was enough to fundamentally reshape major global trade alliances, forcing the EU and Indonesia together after years of delay, the question you really need to keep asking yourself is, how many more of these strategic global partnerships are going to be forged in the coming months, specifically as hedges against unpredictable shifts in U.S. domestic policy? That seems to be a major driving force of geopolitical reaction right now.